Hey guys, welcome to IB Acquisitions, and today we have a special guest. His name is Barry Green. He's a venture partner at FX Consulting Solution, and today we're going to be discussing about the FDA. We're going to be discussing about medical businesses because I know a lot of you are into the medical field of things. Barry himself, he's involved in a lot of medical device projects, so we would like to discuss a little about that, understand how it works in the process for those that are looking to create their own project. Barry, could you give yourself a little introduction about your fields of interest and a little about your background?
Certainly, I appreciate that. Uh, well, FX Consulting was my Chinese firm that I dealt with when people were going to China. The basis of my business is consultants at large, and I'm more of a deal maker. But my background is 30 years of running shoe companies and doing patient adherence, patient engagement. I have three uh, programs that I patented for big pharma. And so right now, my expertise, well, my main goal is dealing with medical devices, pharma devices, and healthcare, which are separate things. And after running companies, I had my own sales and marketing consulting company here in Atlanta, which I had for 12 years, where I had major clients like IBM, GE, and GSA, which was the government contract. So I have a vast background. I'm agnostic when it comes to the different types of companies I work with. But right now, because of my reputation, a lot of people come to me for medical devices, pharma, and healthcare, which are separate units.
Appreciate that a lot. So we want to actually step back a little bit. We were just having a conversation about a certain company and multiples, valuation multiples, and what you're seeing right now. Just tell us a little bit about the multiples that you're seeing in the industry that you're dealing in right now, and what is it like? Because it's going to be higher than the
Yeah,
average multiple we
yeah.
go after. So
What do
let's
you
just touch
what
a little bit.
you were talking about a multiple of what, two before our conversation started?
Three. Yeah. My deal specifically, we're under a two multiple what we're buying it for, but it's well above that what you're looking at, right?
Yeah, between 6 and 10.
And that right there will scare a lot of people. And why is it that kind of multiple? I know a lot of banks, they're kind of like, hey, unless you're some kind of AI enabled company or anything like that, SaaS more like, more likely, they tend to, be hesitant on those kind of multiples when you approach a bank or financing institutions. I mean, even investors to get them to agree on that valuation.
Well, you'd be
How do you?
surprised. You'd be surprised how many uh, investors are in healthcare. Well, fintech, all of those types of companies, health tech. They call the names change. They do the same thing, but the name changes. It's it's more putting you don't kiss a pig, and but they change the name. They call it something special, but reality is they're the same old thing. And everybody wants to get into healthcare because the multiples, the sales are all there. Nobody turns you down, and everybody looks at you as, are you the next J&J? Are you the next Janssen? Are you the next Ethicon or Pfizer, which were clients of mine? And their whole thoughts are different than most of your maybe your audience is looking at. And it's less likely to fail because they're big. And years ago, all of the big companies started to buy all these other companies. Uh, you know, Pfizer, Johnson, and you can see it now because of COVID. Johnson and Johnson, Moderna, Pfizer, they all make products for COVID. So yeah, the multiples are heavy. They're not turned down, and there are many acquirers who'd buy it without sales because the IP is more important than the sales. They know it'll come.
So would you say that the IP has plays
It's
a
it's a
significant
major
role in
part
that?
of it. It's a major part of it.
Yeah, but how would that play a role in this industry versus having IP in another industry?
Well, that's where the deal maker puts together. It's the industry that the finance people don't get involved till the very end, because right now the scientists are the first people involved in it. And if they decide to say it's a no-go, the finance people walk away. And I had a client in Japan that said, we want this done. And they were interested because they spent 5 to 6 years with 80 engineers trying to do what a small little company in Australia was doing. And that's why we could talk to them. But there were other problems, as I told you before. But the fact is, the IP is the most important part. If you don't have it, you're not part of the game. And it is a game.
Yeah, absolutely, absolutely. Now, with when you're looking at these deals, because you're a deal maker, how does it take? What does it take exactly to get to doing deals like you are, from starting on a small micro level, looking at 1 to 2 million to $5 million deals,
Well,
and
that's
then
what
to
the guy in Canada was doing, as I said, with wound care. Uh, you know, the big companies want to buy these small companies. They're because they're the ones that do the research. They don't have to pay for it, and they buy them after they know the IP's taken care of and been approved. Then they buy the company and they absorb it in their company. That's what Pfizer did. Johnson & Johnson has 165 separate subsidiaries. People didn't know that. You got GE Healthcare out there. So the deal maker has a choice in looking at the whole therapeutic categories, how they work, and sometimes you throw them out. You got to be able to walk away, and that's what these guys do. Is they'll take it to the next level, and they'll wait until the guy doesn't have enough money to continue, and so then they swoop in, they buy it out of the bankruptcy court, or they buy it for a cheap price.
Yeah, of course. So, and that's more of a on a macro level
Yeah.
there. And now, medical devices, I kind of got into a couple of years ago. We started looking at level 2, level 3 devices, some with disruptive potential. Now, I initially pivot to another industry. It's just because the capital raise required at the time, it was just a bit more than I wanted to chew at the time. So we decided to pivot into physician practices. For someone starting out and just looking at deals, want to do a couple deals to just get their feet in the door, would you recommend going into the medical device route, life science route, or would you say somewhere in healthcare would probably be a better start just to get their foot in the door?
Yeah, well, I've always separated the industry into three categories: the healthcare, which practices the HCPs. Uh, Home healthcare is going to be the biggest thing going right now, and it is in the United States. It is in China. It's an older population, so home healthcare and the products that go with that home health care. You have the anti-aging, and you have hospice, are all part of the healthcare part of it. Then you have pharmacy, the pharmaceutical products, and then you have medical devices. Some mix, some don't. Some are acquired separately, or what you want to dip in. Now, what you have to do is you have to have partners before you get started. You have to find out how their therapeutic medical device people are engaged. They normally have a board of directors. They're not money people, they're all scientists. So you hook on to those type of people and say, okay, you have, like you're having the podcast, and you say to them, you try to find out, okay, you tell me what the biggest thing is going. What are you working on? What is your research and development teams doing? The bigger companies They have big deal makers. They sort out with guys like me what's new in the industry, whether it's pharmacies, orphan drugs, medical devices, and in your case, it could be straight healthcare, private practice. So I categorize those things separately.
Yeah, absolutely, absolutely. We're just here trying to get the camera situated here
All
real
right,
quick.
no problem.
Now, that being said, we appreciate the insights. You said something about board of directors. When I did this myself, I had a scientific advisory board. Basically, I had a doctor slash scientist who was the lead, looking at these technologies for us to be able to tell us exactly, hey, this has potential. Don't waste your time on this one. Now, on a typical board of directors, a lot of people have a lot of questions. Some of them are confused about how to really utilize the board of directors. Some even get confused between the board of directors and the actual managing the management team, right? That's going to be active in the day-to-day or just overseeing the operations of the acquisitions of the subsidiaries. How much different would you say a board of directors is when you're dealing with that industry, specifically medical devices, because you need a lot of scientists, a lot of guys, with a brain power, so to speak. And a typical board of directors with other acquisitions, if it's a service-based business, you're not really looking for all that. So is it any difference there? And when we're looking at some kind of equity split, are the structures any different? Right. Are they going to be any different in structure?
It's going to be, you're going to have two sets. You're going to have your advisory set, and then when it gets going, you're going to have your board of directors, the money people. So you're really going to have, in the beginning, you're going to be heavy on the medical side, as you found out when you started your venture, and then you move into the money people to run the business. So you're going to have a few are going to transfer. You're going to have a few that don't want to be on the board anymore. They want to get paid out. They want equity. And then their job is done. And now you have the guys that are going to oversee how you run the business.
Right. And that's very different than, not that different in structure, but I guess the payment wise, compensation and the equity, because there's a lot of guys that you would have on a deal team that you really wouldn't have on a board, like a scientific board, right? So it's very similar, but slight variations there.
Well, I don't look at them as board members, maybe one or two. I really look at them as advisory than anything else. The medical, because they spend all their time on the medical side, and you would need that even if you go into what you're doing with a single practice. He probably, when you buy that business, he's going to be part of your board because he's going to know how it runs. And you have to search out who are the best guys to run that kind of business, because there's all kinds of things with GSA, CMS, which you're running into. So you have your advisors that pick it out, and then you have your money people that make up most of the board on the operational side.
I'm glad you touched on that. So I kind of did the same route when putting my deal together. The board, my team, we actually pulled capital through them, right? So what kind of advice would you give to someone looking to put a board together, but they are kind of reluctant to ask that board or those board members to bring on capital? A lot of people say, don't ask your board members to bring on capital. So what would you recommend in a case like this? Because myself, I really don't want anybody part of my team who, and I guess it depends on how much they believe in you in the deal. But if you have a deal that's worth anything, especially if it's a hot deal, you're going to have members who say, look, I know a guy, let me connect you with this person. So how do you feel about board members bringing capital to the deal or versus just not anything at all?
It really depends. It really depends on the person. Some guys are in it for, hey, I want my monthly allowance, what you pay me, and my travel and things like that. I was involved with a number of incubators, and I was always sitting on the board for the incubator, as to pick out the type of program or the type of deal that we wanted to do. And we'd only look for advice from the medical people. And then it was really the money people that made it up. And you'd split between, okay, we want payment for it, and we want equity, or we want equity for it. So it was normally a split. The board will tell you what, if you ask them, what do you really want out of the deal? And most people, some look for it long term, some look at very short term. And you have to decide if you're comfortable with that guy on the board of directors that's got no vested interest in it.
Yeah, and that's something I went through myself personally at the end of, even at the PSA stage with my deal. I ended up having to replace a few board members just because some of the people, they will actually they will give you one image. And then if you let them communicate with the seller, because in a deal, there's a lot of communication that has to happen, and a lot of people have to be on the same page. And the team member, in many cases, especially the M&A team, they have to have access to the seller. You can't be the only one who's that, bridge or mediator. It'll speed things up. So you have to be careful about the members, because some of them, again, they'll put on an image, and then behind your back, it'll be something else. But the image falls back on you, how you guys look as a group. So it's extremely important to have that right team together, but it takes time. You can't just, the first team you put together isn't going to work like a well-oiled machine. So it's going to take time to have the right people to work together, but they have to be active, though, to pull it off. Like, you have to be active.
You have to have your meeting. But for an example, this company I had, my client in Australia, he had 105 shareholders, but only 5 made up his board of directors, who were very experienced in medical devices. And because the others were in it for, the money, their investment. But his board was strictly made up of combination, where all of these medical device people were also the presidents of some of the medical device companies. And he had it both ways, because they could handle the questions asked by the investment people that were going to invest in the company. But the company themselves, the investment company, would have their own people come in and talk. Normally the scientists, the research guys, they would bring in people from Harvard and Brown that were experts in that therapeutic category in the beginning, and they'd give a thumbs up or a thumbs down on a deal, and that was it. If they gave a thumbs down, the deal was over, plain and simple.
That's more of a committee style.
Yeah.
I don't too much like committees myself.
Yeah. Well, it's the fish stinks from the head sometimes, and you don't want somebody to come in that has an attitude that, the best guys in the world, they never say a word. They just sit and listen, and when they talk, it means something. And can you imagine Warren Buffett on your board, what you could get out of it?
Of course, absolutely. I mean, that's definitely an exception. It's just, my thing is with meetings, even with my team, we tend to not do a lot of meetings. If it's extremely concise, short. We're not going to go an hour, 2 hour long, unless we have the seller's counsel, or all decision makers on that line. We have to actually really get down to it. But frivolous meetings, man, wasting time. I'm not really.
Well, the thing is, with the world is a little different now. And with Zoom and all of these things, you can hold a board meeting in a half hour with everybody online, and that's over. So you don't have to bring in all of these guys to fly in the old days, put them up in a hotel. And, so it's easy. You put Zoom on, Skype, Microsoft Team, and all of a sudden you have a meeting. But you only put the board of directors on. They meet every couple of weeks, because they can go on for a half hour and it's over.
Yeah, of course. So look, real quick, I just want to touch back on something you said with these the multiples you're looking at. Now, do you put the deals together And what does that mean exactly when you put the deals together? What I'm trying to get to is, are you looking at a multiple of EBITDA for those, or are you looking at something else? Obviously, bigger companies have, tend to have diversified streams of income, so they could actually afford to make an acquisition based on that metric EBITDA. But we look at, we're looking at 3, 4, 5, 8, $10 million deals. It's a bit more important for us to look at that cash flow and be more
Yeah,
honed in. So are
your
you making those?
multiples are different,
Yeah, but are you strictly just the multiples when you present these deals to investors or whoever? Is it based on the EBITDA multiple solely, or what kind of metrics are you looking at when you're looking at these
Uh,
medical devices?
well, I have a problem with EBITDA. Uh,
Let's talk about that.
okay,
You're speaking our language now.
Yeah,
Let's
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 talk
okay,
talk.
about
Let's get into
that.
yeah.
that.
I have a real problem with that because on the money side, you start looking at EBITDA and you don't look at the future down the road. Most of my clients don't even bring that up until the very end because they're more worried about the revenue, what the market's going to look like. Those are the questions that we're asked, and every one of the decks that I have that these companies submit, they don't even talk about EBITDA.
Yeah,
They
but isn't it the industry standard? Like, what are you talking about here? I mean, look, me personally, Valentino, my partner personally, we actually have campaigns against EBITDA because the guy, look, and you're looking at, and the thing is, you're looking at, I mean, larger deals. We're not looking at
Oh,
deals
I'm looking
anywhere
at
near your
small
size,
deals.
you know.
A guy that has a million, 2 million, 3 million, 5 million. We look up to 10 million.
Mhm.
I look at the middle market. I'm on the side of the small guy who's going to be selling it, getting the investment, getting a merger, doing something, but they don't have the knowledge, and one of the questions you asked me was small deals versus big deals. Well, sometimes the small deal, the guy, you have to hold his hand the whole way. And if you say EBITDA, they go, "What's EBITDA?" And you have to go through a training exercise on, hey, it's not going to work. The guy goes, "Well, what do I need EBITDA for? I just want the money. I want I want 10 million for my business based on my IP, based on the market." They're not business people or investors like you are. So EBITDA is really not there. That's the last thing that I see, whether it's from their research development guys with the university to who their investors are. They're not pushing EBITDA. And I hope that doesn't offend you guys that look at it that way.
No, no. I mean, again, a lot of people swear, up and down, left and right, that this is the way to do it. In fact, I believe one guy said he's the EBITDA king. He doesn't look at anything if it's not EBITDA. And I'm like, are you making acquisitions this way? He's like, yeah, that's the only thing I look at. And we always say, hey, look, you're going to like overpay for that deal. And in fact, like your chances of going bankrupt in a couple of years is higher if you're just looking at that solely, especially if you're looking at small deals like this. And these people always get their panties in a bunch when we say that, as if we're just speaking like some voodoo magic or something like that.
Well, let me ask you, let me say this to you, and I can ask the question at the same time. Uh, a deal, a deal's placed in front of you. You want to make a deal. And you're talking to the principal owner of that deal that's put in his own, he may have mortgaged his house to get it started. He has, an innovative product. Are you going to talk to him about EBITDA, or what are you going to talk to him about?
Of
No.
course, you gotta educate them on the cash flow.
Yeah. And cash is king. I don't care what anybody says, and that hasn't changed in 100 years. I keep a book around my office all the time. It said George Washington, deal maker in charge. People don't realize that he was an entrepreneur at the beginning of this country. The and some of those practices that he had are done today. And when you read the book, I would recommend it to anybody that wants to do investments or how to do it, to read the book. And it was written about George Washington and the deals that he made. And it's what every investors should read the book because it still goes on 275 years later.
Hey Barry, I got some questions for you.
Okay.
So the first one is, what are the top three mistakes medical device companies commit? Startups, essentially.
Um, well, the first biggest mistake is ego.
Mm,
That they think they're above the marketplace, and really that's the main problem. From there, it comes to, hey, this is my invention, and it
right,
should go for a lot of money, and it doesn't, because not only doesn't have the backing. That's one of the biggest mistakes, is there's a conflict between the buyer and the seller. And normally the seller has an ego problem because of, I got such a great product, whether it's AI, or it's whatever it is in the industry that AI makes, because that's going to be the new best thing, is everybody in the medical device wants to attach it to AI. That's, so they're looking at those type of things. But
right,
that's the ego, is their lack of acceptance, their lack of knowledge other than what they do. They don't have any, they don't do their homework. They don't look at all the aspects of running a company, because most of these guys can't run a company, and they have to bring an outsider in to do it, and they don't want to admit it.
I
You've already
bet
run
you.
into those people, huh?
I bet you've ran into many of those.
Yeah,
Uh,
they exist in every industry that you may want to invest in.
that is true.
Uh, it's just, a little knowledge is dangerous, and you deal at the smaller level with, you have to hold their hand through the entire process. It's
Right,
frustrating, but that's how smaller deals are made. You have to hold their hand, make sure they understand what's going on, how long it's going to take. Most of these guys can't wait that long because cash flow is a big problem for them. You
right.
know, they'll say to me, can you get me 100, 200, 300,000 so I can fill the orders that I'm getting? And, you know, wow. And most of them overvalue the company that they started.
Let's talk about that. I want to talk about valuations. That's my passion. I got a few
Okay.
questions about that. So, medical businesses, what is your approach with valuations? Do you take a cash flow base, asset base, or a combination of it?
Combination.
Combination.
Okay. But the main thing we look at is, that I look at personally, is, okay, how big is the market? Do
Okay.
I need 1% of the marketplace to have a very nice little company down the road? I can sell it to a bigger company. But
Right.
how big is the market that I'm dealing with, and how much saturation exists from the people that are in it right now, and who in the industry are the big players. So I separate
Mm,
it that way, and I say, you really don't want to be, you can't knock heads with these guys. Okay,
I got it.
you got it.
Yeah.
We don't want to knock heads with them. We're not big enough to knock heads with them to even start, unless they have an innovative product. That's the
Right.
key to this thing. Because what separates, as we talked about hips, what separates
Right.
a hip manufacturer or somebody like that? Do I want to knock heads with Smith and Nephew or one of those guys? Uh, you know, I may not want to do that.
Right.
So they're
Um,
going to have to look at me as something different. It's not a me too like it is in pharma.
right. Correct me if I'm wrong, but I've heard that people say that the billions are made through innovation. Is that correct?
That's correct. That's called the me too. Pharmaceuticals are me too. Their product managers are little CEOs of a drug. They make
Okay.
all the decisions. It goes up the ladder, but they're the ones that start the process. And the first thing, well, there's two things that exist for them. Number one, There's 26 letters in the alphabet, but they only know what three of them are, ROI. So that's the first thing they look at. So there's only those three letters that they worry about.
Yeah.
And you've already run into this. And,
Yeah.
so, so that's the biggest thing. And then they'll ask you, okay, if I do this, who else in the industry is doing it from a marketing point of view? Because if you look on your TV every night, especially at dinner time, you have every product known to man shows up every 30
That is
seconds,
so true.
so it's a Me Too industry,
Right.
except when a serious problem hits, like COVID, like monkeypox, when HIV, uh, when those products come in, everybody jumps on those because you can imagine the government paid in the beginning $475 million to get things going with COVID, and
Right.
those three companies that made up the balance of that and were paid for by the federal government. So
Let me ask you a question. Is it possible that a drug could be FDA approved yet undergoing clinical trials?
no,
No.
except in the government, they can waive that. They can say we're going to do the exception, like COVID
Mm.
was the exception, okay? Because Moderna and Pfizer and Johnson, there were only three in that category, and they needed to get it out fast, and they have the
Right.
ability to waive it.
I see, but it would be
In most
for
cases,
extreme cases, right?
yes, in extreme cases,
I see. And for you to even consider waiving that, I suppose there has to be some sort of test prior to releasing.
yeah, they have to do. They set up a quick test to make sure, because they have to try to get, they can't get a full study going, and they need something, and they'll do just like with Johnson or Pfizer. They started out with adults. There's a new product for the fourth booster shot is
Right.
only made for people 65 and older. And in the beginning, no children under 12 could take the medicine
Right.
until there was enough studies done on that particular category.
I
You
see.
touched on something earlier, real quick, about the deals, and I actually wanted to touch about post acquisition and integration, right? And what you see is, and I think this goes hand in hand and with some of the mistakes that you see medical devices make. So with post integration, is that anything like single physician practices, or is that just on a in a league of its own? Because a lot of post integration, day one acquisition, it's extremely important, right? You have to make sure you have your P's and Q's and everything lined up to be able to have let the staff have confidence in new management per se. So how important is it, and what are is there any dichotomy with the post integration
Yeah,
with medical devices and just basic services businesses?
it's across the board. If you put a scale on that of 10 and 1 to 10, and I would say it's as important as up as an 8 of the 10, that it's important that an integration takes place, that your employees know exactly what's happening, or you're going to have an exodus as quickly as you've never seen before. And especially in the environment we're at now, they're having trouble hiring nurses. You're nurses could be uh, nurses do everything. The doctor doesn't do as much. If you've been to a doctor lately, an internist, your primary care guy, always nurse comes in, does the blood pressure, that they do the testing, they give the shots. The doctor comes in, asks a few questions. The average time from a University of Michigan study a number of years ago, the average doctor time is about 3.5 minutes that they give you. But
That's
that's what
incredible.
of course, except with Medicare, they have a whole type of thing they have to fill out for CMS. So that's why a doctor wants to see you every 3 months. They only have to do the Medicare situation once a year. So that the doctor actually sees you if you time it 4 minutes at best, that you can ever talk to him. He shakes your hand or gives you a bump now, because they're all in mask. And so the integration is important across the board, not just in medical, but in every phase. Now, a lot of these guys will hire somebody on the big scale. The prime example is Jack Welch. Everybody wanted to be the next Jack Welch with acquisitions and stuff. And Bob Nardone was his key person on his board. And he went to when Home Depot was looking. He recommended Nardone. Arthur Blank, who owns the Falcons now, he brought in him. Well, the Exodus and the Home Depot tanked when he took over, and they had to get somebody else. Arthur Blank came back, and Bernie Marcus, who were the two partners in that, came back. So the integration was important, even at the top levels, because it's not just the bottom levels. It's your middle management and senior management going to split. So I see that as an important, really part of the whole process.
Now, real quick, just a simple question. I'm getting some questions here. What is the main difference? What would you say between growing through acquisitions and organic growth? What's the main difference you see there?
On the smaller guy, it's the growth. It's just there are guys that will take it from 5 million to 10 million. It's internal. They've decided, they made the decision in the marketplace. The marketplace is so large that they can grow it with the right people. The other way is it's a marketplace that's tight, and they're going to have to try to acquire the little fish. They're a shark, and they're going to acquire the little fish. And even on the smaller companies, and you may face that with your single practice, they're going to try and buy another practice that may have more docs, but it gives them an advantage with what's going on, of how they bill, of how they service the patient, how big the nurse is, how many units they're going to have, whether it's a large practice or whatever. So it's really depending upon the vision of the owners, the people that run the company, how they want to grow their company, whether it's through acquisition, and that may change over the course of time. When we hit 10 million, we think we've really topped off. We need to buy somebody, and that's when that decision will be made at the time that the owners decided they can't grow internally any longer.
Okay, great. Valentino, you said you had
Yeah,
a
let me
question you
hop in
wanted to
there.
chime in.
So, how would you approach businesses like we were speaking earlier about projects and patents, right? That aren't cash flowing. Would it be based on the future value? And if so, would it be contingent? Would it be a contingent offer if the results don't match expectations?
Absolutely.
Okay.
Because basically that's normally it's at the tail end of a deal that
Okay.
the real risk becomes, hey, we have a $5 million company we're going to buy. And, as long as you make the numbers we told you, it's going to be fine. But we're going to put at the end, your risk factor changes at the end of the deal.
Okay.
Okay. Whether it's through licensing, whether it's give backs, whether it's whatever it is. But in many cases, that small guy will never last till that phase, from cash flow or whatever. You're going to have to make a bigger attempt to watch over the management of that smaller company.
Right. Ansi, actually touch on that because you were speaking about how you were buying the patent and paying it with royalties.
Yeah, so what we did was the seller actually wanted 1 million for the patent that they have associated with our deal separately. In fact, the patent was included before in the deal, the total purchase price, and last minute, like you said, at the very end, right before we closed, they were actually saying, "Hey, the patent's not included." That actually delayed the deal 3 extra weeks just for the negotiations of the patent specifically. So what happened was instead of us giving them a blind $1 million, basically a blind valuation, because the patent hadn't cash flow in 2 years. It's because of COVID. So COVID came in, it tanked the sales of that particular aspect of the deal, but they wanted 1 million. The last cash flow record we have is 2019, 113,000. So they actually wanted to pay them over 8 times, right? That patent, what it generated in 2019. So we actually went back, restructured it to where we're only paying them 10% royalties for the patent for 3 years. But if those fees don't eclipse $1 million, the patent is actually deemed to be worth less than 500,000. And in 3 years, we'll have the option to purchase it at a proper valuation, which at the time it'll probably be 200,000 or so, something to that effect. But you have to watch out for intellectual property and just not give a blind valuation, because these things it's a bit more complicated to value. From my experience, what we've been dealing with valuing IP, it's not anything like a tangible business, anything like that. So it's very difficult to value those and get a proper valuation on them without having the cash flow associated with it. The seller will usually tell you, and real quick, I'll let you speak, Barry, but the seller usually like to say, well, I've put in 10 years, I've developed it, and all of this, but really it has no value because we have to put millions into that patent behind it to get it to where, its actual potential is. So you'll see a lot of that, but the way we structured ours is that we're just going to do the royalties, because in 3 years, we know for a fact we're not going to pay them anywhere near 1 million, which it works out for us, and they still are able to sell the patent. Well, basically market the patent, if you will, but we have right of last refusal. So they have to have a real offer presented to them, and then at the end, we're able to say no, we'll buy it. But again, the way you're dealing with IPs and stuff like that, it is very tricky to value them without having that cash flow associated with it. So in my scenario, it was better for us to do a 10% royalty fee.
It's always, everybody wants to do the licensing, royalty fees. The owners don't particularly like to do that because they know that it's a risk factor that somebody else is taking, and you're saying, well, you got to take some of the risk with us, and the only way that you can do that is hold back the money at the end, because that's where your value is. And what if they're holding something that they know that the patent isn't going to work? Are you penalizing them because they know something? They have 3 other patents that aren't included in the purchase price, and nobody knows it.
Yeah, but I think a dynamic earnout structure for that specifically would work great, because you're able to adjust. You have basically a crawback, right, in the agreement, and you're able to adjust the price that you gave them. So I see again, a earnout would work great for these kind of structures when there's just too much uncertainty involved. But it has to be dynamic, though. It has to be able to flow with the years and the cash flow of the company and stuff like that.
Yeah, that's the same thing in every case. Uh, even though they invented it, you have the IP involved. They don't have, that's commercialization. What's going to happen? Do you have the infrastructure to make it work? Because even with the IP, if you don't have the infrastructure, you may get to commercialization, but you don't have your total infrastructure in place: sales and marketing, operations, chain supply, and
R&D, stuff like that.
Yeah, it's all going to fall apart if you don't have all of those things in place.
Exactly. So yeah, Valentino, we did have to switch it up a bit, but it worked out a lot better for us. We ended up, saving 1 million, right? So that's less capital I had to raise, and everything's working out a lot smoother. They were reluctant, to Barry's point earlier, to taking that royalty, but I told them we it's gonna delay the deal, and they were not interested in that. So, but I couldn't give them just a blind $1 million valuation without knowing anything, and it just cash flowed 2 years ago. So.
Well, I have one rule of thumb. You have to be prepared to walk away. That no matter what it seems like, uh, it's just not there, and they want too much money. They don't want to do what you're asking. The negotiations aren't going well. So, at what point do you walk away?
Yeah,
That's
and I
the
think,
key.
but the thing is, a lot of people in our community, I say probably 30, 40% of the people in our community, a lot of them are, they get to a place where they are afraid to walk away. We've had this one individual that was in our group a while back. He actually owed a seller. He owes a seller 250K, right, Valentino, something like that.
Yeah,
Um,
250,000
yeah,
breakup clause
yeah,
he signed. He wasn't able to
exactly.
procure financing, and the deal fell through.
But the thing is, and you could touch on this, Barry. I'm not sure if you see this in your deals, but the deals that I've come across, the sellers I've spoke to, even my legal team, M&A team, it's not really typical to make a earnest money deposit when you're dealing with acquisitions, business acquisitions. I have a real estate background, so that's typical when you're talking about real estate transactions. So in the individual I just described, in his case, the seller wanted him to make a 250K earnest money deposit, which he couldn't make. So they said, all right, fine, let's do a breakup clause of 250K for any reason. If it's, other than fraud on my end, which is the seller, they said, you can't back out. He accepted it, and he fell into that trap. So do you see earnest money deposits, in your deals at all?
Yeah, well, you
Yeah.
know, I see it. I see it in a lot of different things. For instance, I have a client that has a really great product. He has a factory, but he's down to three people, and everything that he does, he needs to pay COD for his supplies to even put the thing together. And he'll call me up and say, "Can you get me 100,000 so I can make payroll?" And you can't always do that, and you walk away from the deal. You say, "No, it's not going to happen." It's a great idea. There's a lot of great ideas. There's a lot of things out there, but at some point, when I used to negotiate in the shoe company, I used to have the United Steelworkers of America was the group that represented the factory floor. And one of the things I always told them is we do just like we talked before this meeting to get used to things, we'd always meet them before. And as you know, I grew up in the area that you're in, and they'd always tell me, this is what we want. We try to get everything out in the open before the actual negotiations start. But I'd always tell them, well, this is non-negotiable. Well, in every deal that you make, there's got to be a non-negotiable part that you're not willing to cross over because it's your money, your investment, your time. There comes a point that you have to say no, or even close a factory. And so that's the way I look at the deals. Are you prepared to walk away? That's the big question. The glamour of the deal is more important than the deal itself.
I agree with that 100%.
Right. Let me hop in here real quick. Barry, enterprise value or equity value? Do you use any of those metrics?
Sometimes it's just here again, it all depends who you're dealing with. Uh, your seller, you use those metrics if you're with a seller that it is at least knowledgeable in what you're doing. When they're not knowledgeable, you could talk to them till you're blue in the face. They're not going to understand a word you're saying
Right.
because they're only looking at the big picture. That's money in the bank.
Right.
Okay, we
Right.
settle on two
Absolutely.
million. That's what I want.
Let's talk a little about negotiations, because I tend to see a lot of people have problems with coming to terms or prices that make sense for both parties. Now, the approach I used to take when I would speak with business owners, because I noticed in the small business range, a lot of these individuals are not very business savvy or financially. So me complicating words or using metrics, right, throwing out EBITDA, notepad, free cash flow, it confuses them, right? They say once you confuse them, you lose them. So the approach I would take is, when people tend to negotiate, they tend to take a pawn shop approach. You have, say, $1,000 iPhone. You walk into the pawn shop. You're the seller. You're the one looking to sell. They're the buyer. So they have leverage in essence, and it's either me or you. The way I like to open up the conversation is, look, John, I understand you've been in the market for about 10, 20 years. You built something that your community needs. You built something that your employees depend on. And we would like to grow and expand that. And for us to do so, we have to retain cash flows in the business. So the first thing I want to do and put in their mind is, the business needs cash flows to grow. The employee needs cash flows to live. So you putting everything in your pocket, I don't think is the most ideal, right? So opening up that conversation, I start basing myself on the financials of the business. And before I even speak numbers, because that usually tends to confuse them, I try to speak terms. I want to figure out, are you looking to retire or are you looking to expand? Because depending on either one of those, the structure would be different, right? If you're looking to expand, he's looking to stay on board. So what we will do is have them retain more equity in the business, because the business is going to eventually grow, and we would like him to cash out on that growth, right? Now, if he is looking to retire, the approach we want to take is offer them more seller finance. We try to pitch it to them as a retirement plan where they collect their money over a period of years on a monthly basis. The reason is just to ease on capital gain taxes. Now, from your experience, what approach do you find the best when trying to explain to a seller terms or price?
Well, I start out every deal with the first question is, how much do you want? What's your walk away price? What do you think is your walk away price? What do you think the business is worth to you? Because people will tell you anything, and
Right.
you'll know right away what you're dealing with. If you know that this business is only worth, because you've done your homework, you've done your due diligence, you know what other people in the area are getting, you know what other practices are getting, and that you say, we know that this is a $2 million deal, but the buyer, but the seller is thinking that my business is worth $10 million.
Right.
You started negotiating at that point. You're at 2, he's at 10.
Mm,
Where are we going to go from here? And that's the walkaway side. And you could live with a deal that's structured at 3.5, $4 million, but that's the best you're going to do. How you
right.
structure the deal is the important. What you're saying is, are you guys go in and say, how do we structure this deal that both of us are happy?
Correct.
That's that's an old adage. It's just like, uh, we're negotiating, and I think I lost, you think you lost, and we're both happy when we walk away. And it's just you have to make them feel like it's in their best interest to, number one, sell you the business,
Right.
because in 3 years you ain't going to have a business. You know,
So
That
basically,
is true.
it varies. So basically, you're saying structure over strategy.
yeah, really.
That's what I thought. That's what I thought. Yeah, because I always say the strategy doesn't matter much. It's the structure that's really going to dictate the overall.
Because
Um,
in your case, you want to buy a single unit practice. Okay. What are what challenges you with that? Well, it's one owner. He's the guy that makes it happen. If something happens to him, the deal's gone anyway. Okay. Unless you've already absorbed it and worked on the deal for, been running the business for a year or two. Okay. But if something happens to him during the deal's over. And so that's why the structure is so important. Okay, what do you do if the owner or the face of the company, something happens to them? Okay, what do you do next? That's what I always ask myself. Okay, what happens if Peloton, goes bad? And we've invested X amount of dollars in this place, and the bike market's not important. I saw on TV today that the bike market is saturated. You can't get a bike anymore. That these guys are selling purple and green to the men because you want to ride a bike. Okay, this is what it is. So if you're in a mature industry, you can get away with it. In a startup, in a smaller company, you can't get away with it.
I see. Uh, One thing I've noticed with a lot of business brokers is that they come from a real estate background. And I've seen, for example, in the state of California, I don't know in other states, but in California, if you have a real estate license, you're a real estate agent, you can broker businesses as long as they have real estate attached. It falls under commercial real estate. With that said, I've noticed these individuals tend to use comparables. Now, in real estate, usually certain cities, certain communities, certain neighborhoods usually have a price range, right? Maintain stability. So comparables come into play. But businesses, it is not the same. Every one of them have different tax structures, different legal structure, different cash flow structures. Do you think the use of comparables when valuing business, does it provide any benefit or does it just create confusion?
Creates confusion. I don't think, I just happen to have a factory over here and you don't even know what's inside. It's not a house that you have somebody walk through and say,
Right.
okay, this is a 3 bedroom, 2 bath. And they
Right.
walk into my factory and it's 34,000 square feet. And, people are putting things together. How do they do a comparable?
Right. I mean, what can we say? There's a reason those businesses stay up for 12 years and never sell.
Yeah.
Yeah,
Now,
but I mean, it doesn't even really make sense, Valentina, if you think about it, because on a commercial real estate level, I mean, if you're talking about a 1 to 4 units, yeah, that's great, right? That's residential. You could go by comps, but the second you go to a 5 unit, comps are out the window, right? Because if I increase my rent by $50 and I have a 5 unit, that's gonna increase the value of the property overall. I can't do that on the residential side. So I mean, when you're talking about comps, even on that lower level, it really doesn't even make sense. So why would you even attempt to make some kind of comparison with a business like what my business sold for and what your business that's similar to mine? It has nothing to do with that. Like my sell price is not going to dictate your sell price in any way or fashion. So I don't even see why people would go down that route of comparables. It makes absolutely no sense.
that opens up a question I got for you, Barry. Do you believe in rule of thumbs for business valuations?
Yes.
Which one would it be?
Well, let me give you an example. I ran a business that needed a call center patient engagement place, and people would fly me all over by helicopter, TVA. The different people were doing it, taking me to old Walmart stores to put it in. I had done some business with the state of Maine, trying to bring a company there, and everything went out, and they would take me to these places to look at. And in one case, I bought a hospital in Victoria, Texas, and we were going to redo it. And so that's my rule of thumb: is what's it going to look like at the end? When it's all done, what's it going to do? Is it going to be efficient?
Right.
That I look at the whole picture. I just can't take one item. Uh,
Right.
Too many offices. When you're in real estate, you know, right now the market isn't great for real estate. There's a lot of empty spaces. People are now working from home. They're not working in the office. Not as much space is needed. New things are coming out. And so I don't really have one rule of thumb. It's a combination of different things.
I see. Now, another thing I tend to see with small business owners is usually they want to profit on the future growth of the business, right? They tend to say, my business has a lot of potential if you would do this, this, and that. So with that said, they try to justify a higher asking price. Now I usually tend to tell them, well, I understand that, but the one doing the work is us. The one investing and growing this business is us, and it does have potential. But it still does not justify the price because that is a growth assumption we can't validate. How would you approach that?
Um, that's really the mental state of the people you're dealing with, and I see it across the board in smaller deals.
Mm,
Um, you know, Basically they have a set mind about the business, the work, what they think is the real value of their business, even though you're coming in and saying it's not, there's no value on this.
right,
It's going to take us 5 years to get where you think we are. And so uh, that's a hard question that you have to answer with the when you sit down and talk to these people. Do you ask them the right questions about what the business is really going to do? And you're going to look back and say, what can I do? And that's the separation between what they're doing and what they want to do, or what they told you they want to do, when we're only buying it short term, or we're going to get our 2 million out of it, and we're going to move on.
right.
So that's where I see that going.
Let me talk about assets very quickly. There's a lot of industries that are asset heavy, and I've heard individuals say that when you're valuing on cash flows and you include assets, you end up double paying. Let me explain. Let's say we have a construction company and we have about 10 trucks and we have heavy machinery, say about 5 tractors. And those vehicles, say they generate $2 million a year revenue, right? With that being said, say we have 500,000 net income after expenses. Now, an individual would value the business based on the free cash flow of the business, right? The money left over after expenses. And they would see a multiple that makes sense with the return they would provide investors. But a lot of these business owners say, well, I have $1 million to $3 million worth of equipment. Now, that's where depreciation comes into play. A lot of that equipment is not new, is already depreciated. With that said, if I was to pay the depreciated value for that equipment, would that be double paying? Because what I've heard is anything that is used to generate the cash flows of the business come with the purchase of the business, which is based on the cash flows of it.
Yeah, you don't want to do, you know, when you're doing that type of situation, if those vehicles are gone, how much is the business worth? When you're evaluating it, they
Right.
got they got 10 trucks, heavy equipment, but three of the trucks break down. Are you going to pay for them in the deal? When you're when you're told you're buying 10 trucks, but you only have but three are useless, you've already depreciated them off.
We would exclude those.
Yeah, you'd have to exclude them, but
Right.
your seller isn't excluding them. He's looking at the trucks. I
Right.
have 10 trucks.
Right.
So where do I put the value of those three? If those seven, I have to spread out the three trucks that are useless as part of the deal, that
Mm.
you have to put that price into the seven trucks. And when I look at the evaluation of those trucks, I'm going to have to cut it down because they may be old. They wrote it off 3 years ago. You don't
Right.
know if they work. And
Right.
what if they don't work? Are
Now we
you
have a
making,
liability.
yeah, you have a major
Right.
liability.
One thing banks told me when they do asset based lending is that they look at the liquidity value of the assets. So it's not essentially what you paid for, but what it's currently selling for. Because if there was, for any reason, they would need to get their money back, they would have to liquidate those vehicles. And if they're overvalued, well, they're not getting all their money back. So would you apply that same approach when valuing those assets? What is the liquidity value of that asset and pay just that?
You have to.
Okay.
You have to do that. You have to do that evaluation and say, okay, because it's almost like a liquidation. It's like,
Right.
okay, if I have to liquidate, what do I get for this?
Correct. But the business owner sees that he paid $1 million for that truck or that tractor when the market is currently going for 200,000. So then you got to break that ice, right?
Yep, that's all part of the negotiation. But the truth is, uh, when you talk about, you know, what can I get for this?
Right.
If I put everything's on sale, no amount of money is going to be refused, and I'm thinking that this piece is going to be worth $2,000. It's
Right.
like an antique shop. What what's an antique worth? How come some are 5 million and some are 2 million, even though they paid the same price? Could be the name of the artist on a picture,
Right.
and so there's different values you have to put on that.
I see. I see. One thing I want to talk about is licenses. When you buy these medical companies, there are licenses that you need. And if you don't personally have them, could you transfer them from the business owner? Or could you bring somebody with those current licenses to work the business? Or do you need to apply for them?
No, you don't have to. If you're running the business, you don't have to get a license for it. When you do the research, you would want a somebody that has the uh, the authority of having what an MD, an RN, or something like that. But the license to run the business is just a regular license.
Okay,
There's nothing you can do about that.
right. What about the medical licenses? Are there any that are needed
In
for
in which
medical?
ones? You talking about the I would say that it runs the same way. Anybody that runs the business and you're sending out a check
Yeah,
on the level of the regulatory side, you need a license. But most businesses, once you're past that, they have somebody that runs it with the regulatory.
okay,
Just go through the want ads and you can see, well, Indeed or LinkedIn or whatever, you'll
right.
see we want a license to have this person run the business. That's
I
already
see.
decided up front.
Okay, that makes sense. Now, another thing, another big part of the cash flows, or I'd say the balance sheet and P&Ls, would be receivables. What is usually the collection rate on the receivables for medical companies, percentage wise?
Well,
Say they have a
medical,
million dollars in receivables.
well, there's, if you have, you would say it's no less than 4 or 5%. But it all depends how you sell it. Pharmaceutical companies, it's like, well, let's take a non-pharmaceutical company. You can't buy Coca-Cola here in Atlanta because they don't sell Coke. They sell they sell a syrup formula that the bottlers make, so they don't have a receivable problem because they already
I
lock
see.
it up with their distributor.
I see.
So in most cases, they're only dealing with distributors that will pay the freight, don't have a problem. How many distributors have gone out of business in medical devices? You never
Right.
even hear of those, Cintas and whatever. They don't
Right.
have a problem because they're charging the smaller guys cash on delivery.
I
So
see. Okay. But we would have to discount receivables though, because not 100% of it gets
no,
collected all the time.
no, you have to discount it by 10 or 12%.
10 or
I would say,
12%?
yeah, in the
Okay.
beginning.
In the
But
beginning.
that's why a good credit department can tell you what they're doing. What's their daily sales out? What's their daily receivables outstanding? Is it
Right.
at 60 days or is it at 30 days or 45 days?
Right.
It all depends what your terms are.
Correct.
Of
And so,
course, yeah, yeah, no. I was just looking at some of the questions that we were getting from the guests. I mean, I've read over 45 questions so far, and a lot of them we've already asked and touched on. So it's really great. I really want to thank you, Barry, for showing up tonight. I really want to have another episode with you to discuss these large evaluations with these kind of
not so much pharmaceutical companies, but more of the life sciences and medical devices, stuff like that. So I really want to get into a deeper dive. Maybe next episode we could do like an actual scenario breakdown. Open up the spreadsheet and just break it down, so that way
Okay.
we look at some kind of valuation on a company you've worked on, mock-up deal, of course, right? So that way the guests get a better perspective on the crazy multiples that you're looking at, and the merit behind them. I think that'll be great. So Barry, do me a favor, share with our audience where they could find you and get a hold of you.
Okay. Uh, my email address is speakerleo@yahoo.com. It's SPEAKLEO, all one word, speaker Leo at Yahoo. And my telephone number is 770-605-0439. And that's my business. I have an old account. How many AOLs do you have left? Nobody ever hears of it, but I kept mine for 25 years. Steve K still makes money on it. But that's where you can reach me at.
Awesome. Thank you very much, Barry. You provided a lot of insights. And one reason I like to bring individuals like yourself on this podcast and Nancy likes is that 20, 30 years ago, we didn't have the capabilities we do now to share information. So to have somebody experienced like yourself provide information to those who are just getting in the industry is going to save them a lot of headaches, put it to you like that.
I appreciate that very much, and I enjoyed this. And anytime you guys can call on me, I'd be glad to continue any kind of what's going on in the industry or other industries that I've worked on.
Awesome.
Yeah.
Thank you very
Also,
much.
I want to get you on one of our episodes. We haven't started yet, but this the M&A ring. We're basically going to get a deal valued, and we're going to have a few experts to kind of like, basically touch on why they feel like that valuation has any merit, right? And I'd like to have you on one of those episodes looking at kind of more of them on the med tech side. Hey, look, we have to warn you, Barry. It'll get a bit aggressive because we have some guys who think they know it all when it comes to valuing deals like that. So stand your ground.
Oh no! One of the things I've learned a long time ago is, sometimes it's better not to talk and to listen. And normally, if a guy talks too much, it doesn't matter. And I have a broad shoulders, so I can take it. I have the scars from 40 years of doing this, so.
Battle wounds. That's what we call
Absolutely.
it. Of course.
You're
Hey,
a wise
appreciate
man,
the time,
Barry.
Barry.
Thank you very much. You have a good
Oh,
day.
it's my pleasure, guys. Thank you very, very much. And I hope to hear from your people out there at their convenience.
Awesome.
Of course.
Guys, remember, reach out to Barry. He's the man. You have a good one.
Thank you.
Bye. Thank you very much, guys. This was, of course, just a starter episode. There's things we're trying to work on, things we're trying to clean up. Now, for the next episodes, we are looking to bring in 2 individuals at once. We want to provide people different perspectives. Say we bring in an accountant and I'd say more of a CFO and a transactional attorney, and we would look at some businesses, analyze them, value them, and see both perspectives from the legal side and the financial side. And I think building something like that, it's just going to open up the conversation to greater topics. I'll leave you guys at this. I appreciate it, and we're here to stay. So you'll see